Hi everyone, welcome back. I'm Ferlyn and for today's episode, we'll be doing an update on the stock idea Ping An Bank. So technology is becoming increasingly important to all forms of business, and one key area is the banking industry. So it has become a case of you snooze, you lose in the current market, where banks that are slow at adopting new technologies are likely to be left behind. And when it comes to digitalization, Ping An Bank is probably one of the most aggressive banks in town. So it has made remarkable progress since it embarked on its digital transformation strategy in 2016 and has been named the world's best digital bank 2020 by Euromoney, the first Chinese institution to win this award 2 years ago. And over the last 5 years, Ping An Bank has put significant effort into developing its retail business, which focuses on 3 key business segments: consumer finance, retail services for the mass affluent, as well as private banking and wealth management for the high net worth individuals. And part of the retail strategy includes improving its 2 core capabilities of risk control and cost control, which ensures that the bank will grow healthily without taking on unnecessary risk and optimizing its cost to income at the same time. However, over the past year, Ping An Bank suffered a sell-off due to concerns over China's real estate sector, and one key reason behind this correction was Ping An Bank's slightly higher than average real estate loan exposure. So in this episode, we provide an update on Ping An Bank and share some key takeaways from its financial year 2021 results. So generally, Ping An Bank has delivered a strong set of results, recording a positive growth of 25.6% year-on-year in net income, largely driven by its retail business. So in the financial year 2021, Ping An Bank's non-performing loans fell by 16 basis points to 1.02%, and its impairment losses on credit as a percentage of loan assets has also improved. And this was due to a high base effect given that the peak of the COVID-19 pandemic occurred in the first half of 2020. And in comparison to the second half of 2020, we observed that impairment losses in the first half of 2021 grew by 20% before normalizing in the second half of last year. So this sudden surge in impairment losses came from its corporate clients, and while there is no breakdown of the impairment losses, we opine that this could be in response to its higher than average loan exposure to China's real estate developers. So relevant provisions with regards to China Fortune Land were also made in its first half of 2021 results. So while Ping An Bank may have set aside higher provisions, we acknowledge that it may still face higher credit risk given its higher than average real estate exposure. However, Ping An Bank shared that it will strengthen its risk management measures going forward, lending mainly to developers focused on just the Tier 1 and selected Tier 2 and Tier 3 cities with net population inflows, as well as developers that demonstrate strong cash-generating capabilities. So in its fourth quarter briefing, the management also shared that the underlying assets of its developer loans are in good position, with valid collaterals for all these loans. So going forward, Ping An Bank retail business will be a key earnings driver for the company. Its retail business generally focuses on 3 business segments as mentioned earlier: consumer finance, retail services for the mass affluent, as well as private banking and wealth management for the high net worth individuals. So looking at its consumer finance business segment, as of the financial year 2021, over 60% of the bank's loans were extended to retail customers, mostly made out of mortgage, auto, and credit card related loans. So as China transits to a domestic consumption-driven economy, we believe this signals a huge opportunity for Ping An Bank's retail banking business to grow. For instance, credit card loans are usually a function of the consumption level of an economy. And back in 2019, we found out that 75% of China's population of age 18 or above did not own any credit cards. And during the same period, it was also reported that the ratio of consumer credit balance to cash and deposits was only 14% in China, which pales in comparison to the 33% ratio in the United States. At the same time, the increasing urbanization rate in China also suggests room for growth in demand for property and cars. While we acknowledge that property demand is likely to slow down given the cooling measures imposed, we believe that the relaxation of hukou or household registration restriction will continue to create a sustainable demand for property, though at a slower pace compared to historical growth rates. Evidently, there are significant opportunities within the consumer finance space as China continues its transition to a domestic consumption-driven economy. We believe there is still untapped potential within the consumer credit space, which is a trend Ping An Bank can benefit from. Meanwhile, we also see huge growth potential in Ping An Bank's retail and high net worth individuals' wealth management business segment. So the disposable income and personal savings of the Chinese households have also been on the rise, and these wealthy investors are constantly looking for more avenues to park and grow their assets, especially if they no longer see real estate as an investment that is as attractive as before. Therefore, we believe the growth in its wealth management segment will be a key earnings driver for Ping An Bank's retail business going forward. Next, we also believe Ping An Bank's investment in technology is one of its key differentiating factors from other retail banks. So leveraging on its parent group Ping An Insurance resources, Ping An Bank upgraded and digitalized itself using technologies such as artificial intelligence, big data, cloud computing, and biological recognition. The positive effects of these investments in technology can also be seen in Ping An Bank's improved efficiency and lower cost-income ratio over the years. As shared previously, revenue is no longer limited by its number of employees thanks to the accelerated adoption of digital channels. We also observed that Ping An Bank income per staff continued to improve, with its cost-to-income ratio lowering even further by about 1 percentage point in the financial year 2021 results. Finally, amidst the global tightening cycle, China is moving in the opposite direction. Both the 1-year and 5-year loan prime rates have been cut to tackle an economic slowdown. So looking ahead, we can expect Ping An Bank's net interest margins to narrow further as a result of the rate cuts. However, as highlighted previously, one of Ping An Bank's greatest competitive advantages is the support from its parent group. So Ping An Insurance, for instance, under the Ping An ecosystem business model, Ping An Insurance will help to channel corporate deposits to Ping An Bank, while Ping An Bank will focus on extending retail loans. And given how the cost of corporate deposits is generally lower than retail deposits, and how retail loans have the higher yield than corporate loans, this has helped to provide a level of support for Ping An Bank's net interest margin in today's low interest rate environment. Moreover, Ping An Bank has guided that it will optimize its asset and liability structure to mitigate the negative impact on net interest margin. It also strives to continue achieving the highest net interest margin among comparable peers. So overall, we believe Ping An Bank will emerge as one of the biggest winners as China transits to a domestic consumption-driven economy. Coupled with the strong support from its parent group Ping An Insurance, we see strong growth potential for Ping An Bank in the coming years. But with all said and done, further lockdowns remain as one of the biggest risks that Ping An Bank is facing now. Further lockdown will dampen growth prospects, and the bank may also face challenges in terms of asset quality, which is something you should be aware of. But nonetheless, due to the sell-off driven by concerns over China's real estate sector, Ping An Bank is currently trading at a more attractive level. And based on a fair PB of 1.2 times, we arrive at a 2023 target price of 25.2 CNY, which represents the upside potential of over 70%. Looking ahead with its retail-oriented banking structure and strong support from its parent group, Ping An Insurance, we believe Ping An Bank has great potential to grow as China transits to a domestic consumption-driven economy. And that's all I have for this episode. Thanks for watching, and we'll catch you on the next one.